Good afternoon. This is Brian McGann. I'm the head of investment strategy here at Beacon Trust. Once again, I'd like to thank you all for dialing in to both the webinar and on the phone to our second quarter webinar. We titled it The Strong First Quarter. Where do we go from here? A lot of questions have come up, being we've had such a strong rebound in the financial markets over the first quarter. Where do we go from here? So we're going to address that a little bit today. Here with me in the room is our Chief Investment Officer, John Longo. As many of you know, John is also a professor of finance at the Rutgers Business School and Columbia. I'm also joined by Susan Hayes, our head of fixed income, Joe Healy, an equity strategy manager and director of research here. And we'll touch on a few topics today. We'll touch on the economic and equity market outlook. We'll have a few comments on fixed income and the yield curve. Joe's going to give a little bit of an update on first quarter earnings from the S&P 500. We're about halfway through earnings season. And then I'll wrap up with some of the portfolio implications, and then we'll take some question and answers. Before I turn the presentation over, let me just cover the few logistics. Each caller will be on listen-only mode throughout the presentation. When you registered, you had the opportunity to submit questions via email, and we did receive a few, so I thank you for that. We'll address those at the end. Should any questions come about during the course of the presentation, please feel free to email them into the support@beacontrust.com email address, or if you're logged into the webinar, you can enter them into the question section in the bottom right-hand corner. A handout with today's slides was sent via email to all who registered, and you can also download them from the handout section of the webinar. And finally, this call is being recorded, and we'll post it along with our other published content to the Insight section of the Beacon Trust website. That covers the introduction, so without any further ado, I'll hand the presentation over to John.
Thank you, Brian, and thank you, everybody, for joining us today. Now, let me start out with a chart of the S&P over the past year. Now, one of the takeaways I'd like you to take away from today's call is not really to fixate on a calendar year return. So year to date, you probably know the S&P has had a tremendous quarter. We're up roughly 16% year to date. In fact, as of this morning, we were at an all-time high. The market's down about 0.1% this morning. But if you're looking at the screen, this really places it in perspective. We had a huge drop in Q4. We actually bottomed on Christmas Eve. From top to bottom, we fell roughly 20%. And in our view, the year-to-date gain, roughly 16%, was largely a snapback of overreaction of what happened in Q4. And if I had to dissect it, I think three factors were primarily responsible for the rally, and we'll talk about others as well. One, the Fed moved from a somewhat hawkish position, they were talking about raising rates twice in 2019, to one that was incredibly dovish. In fact, our investment committee can't recall a time, really, and we have quite a bit of experience, in 20 or 30 years that the Fed has done such a dramatic U-turn. So this is very important, I think. The second one, which we knew had to end at some point, but certainly added to the market turmoil, was the end of the federal government shutdown. We know we had the longest shutdown on record, and that certainly did ripple through the economy for a little bit. And the third, which is not quite resolved, but appears to be moving in the right direction, is an apparent resolution of trade tensions between the U.S. and China. And I'll talk more about this if we address risks. Now, that's what's happened, of course, year to date, an impressive plus 16. But we also like to see what might happen going forward. And I look at least three indicators. I look at many, but three that I think have widespread use in the economic community. One is called LEI. It's a basket of 10 leading economic indicators. Things like average hourly workers in terms of how much they're working. Credit spread, something that Susan may touch upon in a few moments. Housing prices and stock prices. If you're looking at the screen, and I know this may be a little bit faint, what you'll notice is that LEI has a pretty good track record of declining in advance of recessions. Recessions in the screen are shown in the gray shaded areas. And what you'll see, and this is kind of our theme, that the economy has slowed down a little bit, but it's not shrinking. So last year we had GDP in excess of 3%. I know we just had a print of 3.2% for Q1. Our view is that growth will moderate a little. Let's call it 2 and change. Another forward-looking indicator is put together by a group called the Institute for Supply Chain Management. In plain English, they survey buyers or purchasing managers. These men and women probably have a pretty good feel for what's going on in their businesses. And they have a manufacturing index. So manufacturing, of course, covers a range of industries, including auto, defense, energy, and many, many others. And they do a survey every month. And how you interpret the number is that if it's greater than 50, it signifies expansion, less than 50, contraction. And you can see the number is still above 50. It's a little bit lower than where we were about a year ago, but signifies growth is likely ahead in the manufacturing sector. As you know, services are a big part of our economy as well. And ISM does a very similar survey for the services industry. This may include, of course, financial services, education, healthcare, other things as well. And here we see a similar story, a number greater than 50, but decelerating. So we see a slowing economy, but one that is still growing, and that still gives us reason for modest optimism, let's call it. Now, another thing that may lead to a recession is a so-called credit crunch. Obviously, banks play a central role in the economy, not only in savings, but in loans. So you can think of car loans, mortgage loans, student loans, and when banks stop lending, it could be a problem for the economy. If you're looking at the screen, once again, we see on a year-over-year basis growth, around 5% or so, but that growth is leveling off. Maybe they're getting a little bit more cautious, but they're not shrinking their loan book, at least at this time. So these are 3 or 4 forward-looking indicators that I like to look at, and not one of them is suggesting a meaningful contraction/recession. Now, another thing that's somewhat bullish for both stocks and bonds is inflation. The Fed has a long-term target of 2% for inflation. You can see last summer, we were actually afraid of the economy accelerating beyond its comfort level of 2%. And this is why the Fed said we may have to raise rates twice in 2019. But looking at the right-hand part of the screen, inflation has dipped quite a bit, well below the 2% plus range, especially excluding volatile food and energy. So in plain English, inflation is tame, and this tends to be a positive environment for both stocks and bonds. So to summarize, the economy is in pretty good shape. The unemployment rate, roughly around 3.7%, is among the lowest it's been in roughly 40 to 50 years. So that's positive. Why this is so important is that we know that in the US, the consumer is 70% of the economy. So having a job is the #1 thing that determines your spending. We see GDP numbers that actually surprised on the upside in Q1. Part of that was due to inventory restocking, as well as a somewhat surprising trade surplus. We expect that to diminish a little bit, and we expect growth to be in the 2% range for the full calendar year, which decelerates from last year. And most of the leading indicators suggest continued expansion. So our message is this. We want to see a decline in the economy or the indicators before getting too bearish too quickly. And the recovery has been, I think, largely a snapback from the overreaction in Q4 last year. Now, when we look at prices, and I'm sure you do the same thing when you go to Costco or Walmart or TJ Maxx, wherever you like to shop, you like to see how expensive is something that I'm buying. Now, there are many ways of measuring valuation. One of the most common is PE, price to earnings ratio. It's been in the stock tables of the Wall Street Journal since the 1950s. And if you're looking at the screen, what you can see here is the current PE is around 16.5 to 17. Now, that's about the average of what we've had over the past 25 years, and it's not crazy like it was during the internet bubble. Clearly, if we're trading at 22, 24 times earnings, I would certainly be pounding the table, let's take some money off the table and have a more conservative allocation. But at this time, and Brian may elaborate a little bit later, we still have a preference for equities over fixed income, although it's not quite as aggressive as maybe when the market was down 20%. So I would view this as the market might be fairly valued, and maybe you can trade even higher given the low levels of inflation. Not only that, the stock market, of course, is made up of many stocks. Here's a nice visual website I like. It's called finviz.com, which is short for financial visualization. And if you go to this website, and you're welcome to play around with it, you can adjust the screen based on what variable you want it to show in a heat map or thermographic. So the most common way is showing performance over the past day or year to date. But here is a map of valuation, specifically forward PE. And the way to interpret this map is that something in green is trading at a low PE. For example, you can see many of the financials are trading at less than 10 times earnings. And something with a high PE, generally growth stocks, are trading at high levels. Now, this doesn't necessarily mean the stocks are overvalued. It just means that the companies are expected to have high growth. Looking at the screen, we see Amazon with a forward PE of 47. Well, Amazon's been growing at double-digit levels for many years and expected to do so for a while. We had a pretty solid number from MasterCard today as well. So my point is this: the market is made up of stocks, and we have a number of experts here that spend a lot of their time looking at individual equities and finding value among the aggregate names, not only in the S&P 500, but in the 5,000 or so stocks within the U.S. universe, and of course some internationally. Now, perhaps this is the most important slide if somebody wants to make a bullish case. As I said, our view is one of modest or cautious optimism. There is a risk that I may address near the end of our session on a risk of a melt-up, which would be a good thing, but we don't really bank on that. Now, I know there's a lot going on in this graph, but look at the light blue curve on the bottom. That's our current expansion. So one of our themes is that the current recovery may be one of lower for longer. Just to place this in perspective, if we get to June or July, and I'm pretty confident we'll get there without a recession, this is going to be the longest economic expansion on record. But for the bulk of the recovery since 2009, GDP was growing, let's call it 1.5% to 2.5%. That is far less robust than the prior recoveries. Now, granted, the U.S. economy is a lot bigger, so maybe its growth potential is a bit lower, but the bottom line is there is no imminent need for recession. Not that I think the U.S. economy is Australia, but Australia has gone 25 years without a recession, partially because they're commodity rich and have been selling a lot of things to China. So we prefer to look at the data to make our decisions. We're not going to get scared just because we're in the longest bull market and approaching the longest economic expansion on record. This is also a good chart to remind people of that, number one, the market falls at some point every year. We call that a drawdown. Number two, in let's call it roughly 70% of the time, we wind up in positive territory. Not that this is a statistical fact, but I would point out that year to date, and here we are almost in May, the biggest drop we've had is 2% from top to bottom. Now, I'd love for this to continue, but mathematically, odds are very unlikely. Now, we did have quite a few corrections last year, 3 to be specific, and I would hate to see that again. But the point is, we have a diversified portfolio, partially because of volatility. And volatility has been dormant, but clearly it's not dead. We had a exceptionally low volatility level of around 3% back in 2017, and this was the lowest going back to 1980 since 1995. So just buckle up and be prepared for a downturn at some point, but that doesn't mean that we're going to make a radical change to your portfolio. If we saw strong signs of a recession, that would get us concerned and maybe make a more meaningful change in asset allocation. So to summarize our view on the market, we think the gains we've had year to date have been largely a snapback from the overreaction last year. And frankly, when we were coming out with our outlook last year, we didn't know everything would go in the right direction. We were surprised how quickly the Fed pivoted. We knew that at some point the shutdown would end, and we thought they were making progress with China, but it appears to be going pretty well. And as I said, I think the Fed doing a complete U-turn caught us by surprise, and we're happy about that. So you might say, what do we think from here? Well, the economy is still growing. In a few moments, Joe's going to talk about the solid earnings season we've had, and we expect earnings to continue to grow. So we might expect gains going out here to be proportional for earnings growth. Let's call that mid to high single digits, including stock buybacks. And so we're not super bullish because the valuations are at a 25-year average, and a recession, or at least signs of a recession, may change us to be incrementally more cautious. Now I'm going to hand it to Susan Hayes, our head of fixed income, who's going to talk about our views on fixed income, the bond market, and the yield curve. Susan?
Thank you, John. I'd like to start with a recap of the fixed income markets in the first quarter, and then I have two slides I'd like to review for you in this presentation. So the fixed income markets rallied considerably in the first quarter after the Federal Reserve announced an abrupt policy U-turn, as John mentioned a few times already in our presentation. They signaled no more Fed rate hikes for the remainder of 2019, and this was coupled with a continued patient attitude towards hiking rates. That's been their buzzword lately, patient, 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 and they definitely conveyed that message at their last meeting. So this news came as a bit of a surprise. The abrupt U-turn was the biggest surprise, as it was basically a complete reversal from what the market was anticipating at the end of 2018. If you remember, all the way back to November, December, many firms, including ourselves, had 2 rate hikes built in 2019. And since the Fed came out with their abrupt U-turn, we now have a 1 or less and probably no rate hike call for this year. So once the Fed appeared to be on perma-hold, a risk-on tone emerged, and that led to a rally in longer maturity and lower quality bonds. So for our second quarter outlook, as a result of these Fed policy changes based on lower inflation projections and a softening macroeconomic backdrop, we downshifted our expectations on our range for the yield in the 10-year Treasury for the rest of the year. We had pegged it at 2.25% to 3.25% range, and we downshifted it to 2 to 3%, and we now may be in a lower for longer yield type of environment for the rest of 2019. We do still continue to believe that bonds should be held for income and diversification purposes, and that the excellent fixed income performance that we saw in the first quarter this year will somewhat moderate as the year progresses. So on page 14, we have a chart of the Fed funds rate. This rate hike cycle began in late 2015 with rates near 0%, and the Fed raised rates 10 different times to a point of 2.5% last December, and it looks like this 2.5% will be the peak Fed funds rate for the hiking cycle right now. The next chart has the yield curve over several periods of time. This is probably the biggest story in the bond market right now. If you look at the chart, you can see on the bottom, the light gray line is from 2017, where the curve is normally sloping. Shorter bonds have lower yields than longer bonds. If you move up to the darker gray in March, similar but flattening a little. And if you look at the blue line, it's actually where the curve inverted at the end of March. So in the past, an inverted yield curve has had a high probability of predicting recessions, and this is why the market is so focused on this development. It's important to note, though, that there's typically a lag time of 20 months between an inverted yield curve and a recession. At this time, as John said, we do not foresee recession on the horizon, but we'll diligently monitor market conditions. I think it's worth noting also that this yield curve inversion, which got so much media press and was obviously such a big story in March, was very short-lived. Since the curve inverted, it has actually straightened itself out. So you now have 3-month to 10-year yields normally sloping in the 2 to 10s, which is another widely watched yield spread, is upward sloping now. So it was a very short-lived yield curve inversion, but again, something was noteworthy and to keep in mind. Last December, we wrote a piece on this topic entitled Thoughts on Recent Yield Curve Changes that address this phenomenon. We included it in our quarterly summary. We actually added a hyperlink to it, so if you received the quarterly summary on your email, you should be able to click to the hyperlink if you want to read it. If you didn't receive that or you don't have a copy of it, please feel free to reach out to me or any other team member, and we'd be happy to send that on to you. So now I'd like to pass it over to my colleague, Joe Healy, our Director of Research.
Thank you, Susan. Good afternoon, everyone. I'd like to provide an update on the first quarter 2019 financial results being reported by Corporate America. At this point, we're near the midpoint in receiving earnings results from the companies in the S&P 500 index for the quarter ended March 31st. And at this early stage, earnings are up 2% year over year on revenue growth of 3.7%. Now, clearly, these are pretty modest numbers, but of course, you've undoubtedly heard much about the challenges faced by large U.S. companies over the past 12 months. Revenues have been challenged by moderating economic growth both in the U.S. and abroad. In the U.S., most notably in areas directly affected by the multiple Federal Reserve interest rate hikes that Susan just mentioned, such as housing, construction, auto sales, etc. And it's also been a time of slower growth in the global economy, with key countries like Germany, the UK, and Japan reporting very slow growth, and even China experiencing a moderation in its growth rate. Now, with over 40% of S&P 500 profits derived from abroad, the slowdown in foreign economies has also negatively impacted the immediate revenue trend for U.S. companies. And then there are the expense pressures that U.S. companies have been facing in recent quarters. Rising input costs in certain raw materials, most notably energy. Also, with the tightness in U.S. labor markets, companies are seeing rising wage costs. And interest expenses for companies are also moving up in recent quarters, following the multiple hikes in the Fed funds rate by the Federal Reserve. So it isn't too surprising that expectations for U.S. corporate earnings growth for 2019 moderated quite a bit over recent months. Revenue growth has slowed and costs have moved up. And so going into first quarter corporate earnings season, Wall Street expectations were actually for flat year-over-year earnings growth for the companies in the S&P 500 index. The good news, though, is that based on an emerging trend of favorable earnings surprises here in the first half of Q1 earnings season, it may well be that even despite the top and bottom line challenges companies are facing, we may well actually be in store for earnings growth in Q1, albeit modest, for the S&P 500 companies overall as the results continue to pour in here. Now, I share this optimistic view with you because here today, with 46% of the 500 companies in the big index having reported their first quarter results so far, fully 76% of these companies have reported positive Q1 earnings surprises relative to Wall Street expectations. That 76% compares very favorably to the 66% of S&P 500 companies beating expectations in the fourth quarter. That's 10 percentage points better. And as we think about how 2019 plays out, add to this favorable trend of positive earnings surprises another key factor. It now seems likely that Q1, marked by some profit margin pressures, may end up representing the toughest quarterly comparison period for corporate America for all of 2019. That's because some of the aforementioned revenue and expense challenges seem to be peaking here in Q1. Notably, there's been a pickup in economic growth both here in the U.S. and abroad, auguring well for revenue prospects as 2019 plays out. We had that 3.2% GDP print just a few days ago. And while cost and expense management will continue to challenge companies, we are hearing from our companies in our portfolios on their earnings conference calls in recent weeks that in many cases they're improving their productivity or selectively implementing price increases to offset cost pressures. So it appears as if a temporary dip in S&P 500 quarterly net profit margins in Q1 should mark the low point for S&P 500 profit margins this year, with margins moving up in the subsequent quarters. Now, what this means for overall S&P 500 profit trends is that year-over-year quarterly earnings growth comparisons are likely to trough here in Q1 and move up sequentially by Q4 to high single-digit percentage improvement on a year-over-year basis, something which we think is underappreciated. It's also well worth considering what's happening to underlying earnings estimates for S&P 500 companies over recent months. Empirically, the number of upward earnings revisions as a percentage of total revisions for both 2019 and 2020 for S&P 500 companies appears to have troughed in January. Indeed, upward earnings revisions as a percentage of total revisions ticked up in both February and March, which is very encouraging. In practicality, this may mean that Wall Street's negativity on the earnings outlook troughed just after the difficult Q4 for the stock market ended, arguably a herd effect. And it is quite conceivable that this has set up the market for outright positive earnings surprises versus these lagging expectations over the course of 2019. Now, looking out at 2020 as we see it so far, next year could actually bring a return to double-digit earnings growth, barring any unforeseeable major surprises. So we view the earnings picture for large U.S. companies as one which got much more challenging as some significant negative macros played out over the back half of 2018 in particular. But now we're looking at unfolding developments on the macro front, which are favorable on balance, and a bar to clear of only modest height on the expectations front based on previous fear-driven earnings estimate reductions. So both the strong recovery in stocks that we experienced in Q1, as well as their potential over the intermediate term, are well supported by what we see as a favorable outlook of corporate earnings progress ahead. And with that, let me turn it back over to Brian.
Thanks, Joe. So I just wanted to conclude with basically the implications of everything that you just heard in terms of the way we're managing portfolios. Basically, without a view from a macroeconomic standpoint that we're imminently heading for recession, favorable interest rates, favorable inflation, and as you just heard, favorable earnings growth projections, we're still leveraged in any risk mandate toward equities relative to fixed income. We still believe that clients should be taking risk in their equity bucket. So for fixed income, we're still leveraged about duration equal to the benchmark. In the past, we've let portfolios run down as there was really no difference, but now that the yield curve is slightly steepening out a little bit, we've gone to a more neutral duration stance, still leveraged toward high credit quality. In terms of equities, again, we're leveraged more in portfolios toward equities and do not have any immediate plans to make any changes. Now, again, as John alluded to early on in the presentation, clients may be sitting there saying, well, we're already up 16 or 17% in our equity portfolio, and your forecast for the year was for upper single digits. That's why we kind of want to move away from the arbitrary December 31st date. Investing isn't a race to an arbitrary date. A lot of what we've seen in the first quarter most likely is a result of a bounce back and no change to fundamentals, a bounce back from what happened in the fourth quarter. Again, we've had the Fed give us a little bit of a favor with their U-turn, but for portfolios as a whole, we've made no changes in our asset allocation recommendations, and we continue to do so. We still find value in the equity markets, as John has pointed out, from both a sector weight stance, but also an overall market stance. We find value for clients who have diversified outside of the U.S. and international investing. Down the cap scale here in the U.S., we still look favorably on small cap sectors as an asset class. So again, part of our job here is to maintain a longer term focus while looking at the current picture. So to give an example, if we were to look at what was going on in the fourth quarter and made the decision that there was a big change in fundamentals, we would have taken action in client portfolios to get a little bit more defensive. Now, the fourth quarter is a little bit tough to live through when you see equity returns go from, plus 10% to down 10%, and then, from peak to trough down 20%. But again, with no change in fundamentals, we decided to do nothing in client portfolios, and that paid off. Most of the time in taxable portfolios, we need to take into account any allocation shift that we do will have consequences. So again, to reiterate, as long as there's no change in our fundamental outlook for both the economy and the financial markets, we're recommending that no change in asset allocation be done, no major change. Our strategies are always tweaking, looking for either better opportunities in the equity market, or Susan may be looking for a better value along the fixed income curve. Ermin Civilik, who runs our asset allocation platform, may be looking for a more efficient vehicle to take advantage of an opportunity in an asset class. But again, from an overall asset allocation standpoint, we believe the value remains in being leveraged more in any risk mandate, again, being leveraged more toward the return potential for equities relative to fixed income. So we just like to wrap it up with, the implications to your portfolio and how we look at it as a whole. So I thank you for joining. I will reiterate that, again, if we've prompted any questions, please feel free to email them into support@beacontrust.com or use the questions section of the webinar. So right now we've gotten a few questions in, and I will address, I'll introduce one of the questions, and this one I'll address for John from a macro standpoint. We've gotten a question regarding the concern surrounding the size of both the government debt and the private debt sector and its potential implications for both the economy and asset prices going forward. So John, would you please address?
Sure. Well, there is a lot of debt, and it is a concern. Let me just place it in perspective, kind of say how we got there. First of all, the federal deficit, the federal debt is $22 trillion. Now, that doesn't even include the deficit we have for Social Security, Medicare, and Medicaid. Now, corporate sector debt has also been increasing at a substantial pace, and I'm sure you've read about student loans and other things. So there's a lot of debt. Now, there's some good news and bad news about that. The bad news, of course, is the magnitude. The good news is that one reason why debt has gone up so much is that interest rates are exceptionally low. Economists sometimes call this the carrying cost of debt. The best way out of this is growth. And we've seen some growth last year, this year, hopefully down the road. So having growth and living within your means, not accelerating the budget deficit, is probably the best long-term case scenario. That being said, at some point, we need to pay the piper, so to speak. So how this may occur is, number one, having a more balanced budget. That may not happen at least through the election, but at some point it has to happen. If we don't balance the budget, the market may force more discipline on us. That typically results in rising inflation. So in a rising inflation environment, we might favor TIPS, Treasury Inflation Protected Securities. I looked this morning, right now TIPS are yielding 2.6% on the most common TIP ETF. When you back out inflation, you're getting about 0.6% net. Now, 0.6% is great if the market's falling apart, but if our outlook is modestly positive, we still would prefer our existing allocation to a high allocation of TIPS. Going down the, let's call it pain spectrum, there could be a delay eventually in entitlement program. So I think anyone over 60 or maybe over 50, you're probably okay. But for the younger generation, they may have to wait longer for Social Security or Medicare. And there could be eventually a cut in entitlement programs. How this would most likely manifest itself is the cost of living adjustment would be less than inflation. So, and then eventually you might get a nominal cut as well. So bottom line, if we have debt and it's accelerating, we eventually have to pay it off. Currently, the market's not worried about that. We see that because rates are still low, and it can go on for quite a while. Perhaps the most famous case is Japan, where their economy has been stagnant for 20 years, and yet they're still having interest rates at less than 1%. So to summarize, it's something we're concerned about in terms of when it might impact our asset allocation. If we saw inflation take off, or in parallel, gold really take off, that might give us a sign that the market is worried about our ability to pay. But, you know, it's not a pretty picture, but hopefully one we can solve with growth.
Thanks, John. Another question came in regarding portfolio positioning, so I'll kind of take over this one. Again, the first part of the question addresses the recent returns, and they've been very good. And, you know, if we had a target on equity returns, should we be taking some profits at this point? And again, I hope I clarified that a little bit in my commentary, but no, and again, it's not an arbitrary race toward calendar year end. We've seen a lot of good returns in the first quarter, but again, our view is it was, you know, just a return to a more realistic environment rather than very pessimistic what took over in the fourth quarter. So no, we're not recommending that we take profits here and move to the sidelines. Simple rebalancing back to a target allocation is something that you know we do, and that's fine. But a recommended asset allocation shift currently, based on the factors that we've already discussed, is not something that we are considering across the board. And then the second part of that question was on the equity side. Would it make sense to get more defensive, get into more defensive equities from the growth orientation? And the answer to that would be, to me, would be probably not at this point. We have a low inflationary environment. We have accommodative interest rates. We have an economic outlook that is still growing. So with no inflation, we tend to focus in a lot of our strategies on companies that don't need pricing power, traditional pricing power, in order to grow their revenues and therefore earnings. They're growing as a result of technological improvements or you know, process improvements, logistics improvements to generate, you know, better revenue and earnings growth and so forth, product differentiation. When I think about defensive sectors, I think more in terms of utilities and consumer staples and things like that. But again, with yields on the fixed income side where they are, I wouldn't tend to reach for those income or, you know, the higher income oriented, more defensive equity type sectors. Again, the economy is still growing a little bit slower than 2018, but it is still growing. We're seeing good earnings growth, and we do think that we could continue on this path for, you know, for a longer period of time. So I hope that addresses that question. A third one that we got is a little bit more specific to our risk control strategies here at Beacon Trust. So anyone participating on the risk control platform here, the question really revolves around performance of the Beacon Plan Return and Accelerated Return Fund. So I've asked Ermin Civilek to come in as the portfolio manager of those two funds and discuss performance and to set some expectations for those particular funds moving forward.
Thank you for that, Brian. I'd like to start by summarizing the investment objectives of our two risk control strategies, mainly the plan return strategy and accelerated return strategy that our clients have been investing in since 2009. These investments provide our clients with systematic equity exposure with a managed risk level, which results in a targeted, stable return with a lower risk profile than the overall U.S. equity market. Our goal is to help investors avoid the irrational decision-making traps by eliminating the temptation to market time or to make hasty, emotionally driven, tactical portfolio adjustments. Planned return strategy seeks buffered equity exposure with high single-digit returns over 4 market cycles with substantially lower volatility than the equity indices, and it has delivered on that promise since inception. It's captured most of the domestic equity market returns with less than half of the market volatility, therefore delivering superior risk-adjusted returns and significantly limiting the portfolio losses. It has ranked in the top 10% of its peer group universe, which is made up of similarly positioned strategies tracked by Morningstar, the largest independent research provider in the investment management community. Planned return strategy acted as a ballast in client portfolios, just like a bond portfolio would, except it generated significantly higher returns than fixed income investments over that same time frame. Turn to the second strategy, accelerated return strategy. It seeks to capture equity-like returns and increase the probability of outperforming S&P 500 in modestly rising markets without taking additional market risk. It also delivered on its investment objectives since inception, and it's also ranked in the top 10% of its peer group. Due to the embedded discipline of the investment strategy, accelerated return was one of the best in-house strategies last year, and it remains one of our best strategies this year. It's been outperforming S&P 500, the broad-based benchmark, which is up about 17 to 18% year to date, by 300 basis points, and it's also outperforming it over the past 12 months. And that 12-month period, as you know, includes the volatile period we saw during the fourth quarter of 2018. We attribute this alpha that we generated to the fact that we don't make calls on specific underlying businesses, investment sectors, or market caps in these two strategies. Therefore, they're good complements to the fundamentals-based strategies that we also manage in-house or invest in through third-party strategies. In these two strategies, these risk-control strategies, we're agnostic as to whether growth stocks outperform value stocks, small caps outperform large cap stocks, or tech stocks outperform healthcare stocks for that matter. Investment factors such as these move in and out of favor, and over the long run, it becomes a wash. Now, just like any other investment strategy, there are periods that these risk-control strategies may not perform as well as expected. No strategy in the world can consistently outperform its indices and benchmarks. If there was such a strategy, you would know that every investable dollar in the world would chase that strategy, and undoubtedly the strategy would not function the same way with that massive capital base. In the case of planned return and accelerated return, the periods of underperformance coincide with times when the market volatility or the gyrations day-to-day, week-to-week of the market prices remain low. During such periods, our maximum returns get limited, and we give up the upside in equity returns beyond a certain threshold in exchange for buying that downside protection and that downside risk mitigation. 2017 was a good example of that. Domestic equity markets displayed what was almost like a riskless market. There was no market pullback and no market correction during the entire calendar year of 2017. Volatility was a record low, and we trailed the equity markets, which were up 22%. But our discipline and portfolio positioning helped us in 2018 and 2019. Going back, 2013 was another example of a runaway market when the S&P 500 finished the year up a whopping 32%, and we underperformed during that year as well. Looking ahead, we expect the volatility to continue to normalize, which should bode well for both strategies. If there's a massive equity rally, both strategies could trail the world market indices, but that's not our base case assumption. As John explained, our expectation is for the stock market to perform in line with the earnings growth rate, which is expected to be in the mid-single digits. That's an environment when both strategies should perform well. Brian?
Thanks, Sherman. So we're running up against 45 minutes. I don't see any other questions coming in. I would like to thank everyone for their time in dialing in and participating in the webinar. Please feel free, if we've spurred any additional questions, please feel free to reach out to any member of your team. We'll follow up with you if you've logged any questions after the call, or you think of anything else, we appreciate the business that you do here at Beacon Trust, and we're always here to answer questions and to service our clients' needs. Thank you very much, and have a great day.